All right, let's fast forward a bit. We're looking at the crystal ball for 2026, specifically in the world of reverse mortgages. And spoiler alert, it's looking like a growth year.
Oh, I like the sound of that. But let me guess, it's not because interest rates are suddenly going to drop to zero, right?
Exactly. It's actually about adopting. Lenders are realizing they can't just sit around waiting for the good old days of low rates to come back.
Yeah, John Lunday from Reverse Market Insight made a really good point about this. He basically said 2025 was the wake-up call.
Right. He noted that rates might stay high longer than anyone wants. So if you're an originator, you have to get proactive. You can't just wait for the phone to ring.
It's all about distribution now, getting the product in front of more people rather than waiting for the market conditions to be perfect.
Now, we have to talk about the HECM, the Home Equity Conversion Mortgage. That's the government-backed standard. But Chris Mayer from Longbridge Financial says that's not really where the action is.
Interesting. Why not?
Well, HECMs are tied to the 10-year Treasury rate. If that rate goes up, HECM volume goes down. It's pretty mechanical.
So if rates stay stubborn in 2026, the HECM is kind of stuck in neutral?
Exactly. Which brings us to the real MVP of this story, proprietary products.
Ah, the private label stuff. So lenders creating their own rules?
Basically, Mir thinks the bulk of the growth in 2026 is going to come from these proprietary loans. They offer more flexibility and often more cash to the borrower, regardless of what the Fed is doing.
That makes sense. Steve Irwin from the NRMLA, that's the industry association, backed that up. He said even though 2025 was positive, the FHA numbers didn't fully show it.
Because the FHA product has that massive upfront mortgage insurance premium. It's a huge barrier to entry.
Right, it's expensive. So people are turning to the private market where they don't have to pay that huge insurance fee upfront.
And the investors are loving it. Irwin mentioned there's a robust investor appetite for these private loans.
Which means more innovation. Lunday mentioned we're seeing better loan-to-value ratios and cooler line of credit structures.
It's basically the market saying if the government product is too rigid, we'll just build something better.
There's also a branding element here. Longbridge has this HELOC for Seniors product.
I love that strategy because let's be honest, the term reverse mortgage still scares people. It has a stigma.
Totally. But everyone knows what a HELOC is. It feels safer. Mayer said it blurs the lines and gets the conversation started with people who would usually run away.
So how do they actually grow in 2026? Mayer calls it the lowest hanging fruit.
Let me guess. Cross-selling?
Bingo! Look at the people who got rejected for a traditional forward mortgage. Instead of saying, sorry, we can't help you, say, have you considered a reverse?
It's so obvious. You already have the customer. Just offer them a different menu.
And if you need proof that this industry is going mainstream, look at the money. Blue Owl Capital just pumped $2.5 billion into Finance of America.
Whoa, that is not chump change.
Nope. Mayer views it as total validation. Big institutional money is saying we believe in senior lending. That is a huge green flag for 2026.
So, final thoughts? Is there anything that could make 2026 even better?
Lunday has one wish. If the FHA lowers that upfront insurance premium on HECMs, it could unlock a flood of new borrowers.
That would be the cherry on top. But even without it, between the innovation and the private money flowing in, 2026 is looking pretty exciting for the reverse space.